What's up, everybody? Nate here. So the Federal Reserve just started its FOMC meeting where they're going to go over everything inflation and our economy and how they're going to adjust their monetary policy in the future. That includes their balance sheet runoff and, of course, interest rates. Interest rates have been a huge topic of discussion in the business and financial community, and there is a possibility that we could see a much more aggressive Fed on this next report that they're going to release tomorrow. I want to go over today some expectations that you and I can both have so that we can prepare our money in the future. I want to go over everything that we know, everything that is potentially going to come from the Federal Reserve, how that's going to affect our economy, and of course, what you can do with your money before the Fed actually drops that report, because some things are going to go crazy once the Federal Reserve drops that report. So let's go over first what the Federal Reserve has done in the past and what we can expect. And of course, if you like this video, make sure to hit that thumbs up button below. That raises my interest rate here on YouTube and allows more people to see my videos, which means I can make even more just like this one. Now let's talk about everything the Federal Reserve has done. So back in March of 2022, they raised their benchmark interest rates by 0.25% and started to run off billions of dollars every single month in their balance sheet on Wall Street. This eliminated a lot of demand in our economy, but they figured it wasn't enough. In May, they raised their interest rates again by 0.5 basis points. So at the moment going into this results that we'll see tomorrow of the FOMC meeting, the federal funds rate for the United States currently sits at around 0.75 to 1%. That is a much higher than what we've seen over the last few years, and when the Fed raised their rates back in March, that was the first time in almost 3 years. They got even more aggressive in May, raising their rates more than what we have seen since 2000, and now there is a potential that they could raise them even more by 75 basis points. The last time the Federal Reserve raised their benchmark interest rates by 0.75 basis points was in 1994. Now, since the start of 2022, the federal funds rate or interest rate from the Federal Reserve has been around 0%. This was set all the way back in March of 2020 to kind of incentivize and grow our economy despite the pandemic. They wanted to make it really easy for people to go out and get things like a mortgage or an auto loan or spend on their credit cards. Basically, they wanted people to go out and spend money, and with interest rates going way down and other types of stimulus, it made it really easy to do that. However, we also had really high inflation from supply chain issues and also from demand all throughout our economy because of it. So now inflation is around 8.6% in our economy, which is extremely high, something we haven't seen since around 1982. That has kind of led the Federal Reserve to get even more aggressive with inflation, which is why we have started to see interest rate hikes of 0.25 and then 0.5 and now an anticipated 0.75. Now let's go over some of the expectations that some investors and big corporations have when it comes to these interest rates. Goldman Sachs at the moment is saying that the Federal Reserve is not likely to raise their interest rates by 0.75%. They feel that the Federal Reserve is just not that aggressive and that inflation is likely to go down once we have a lot of things end, like supply chain issues and the war between Russia and Ukraine, and of course China reopening. CME Group is also saying that there is going to be a pretty decent chance for a 0.75 basis point hike. However, it is also not likely. It's important to mention here too that the stock market is currently pricing in a 0.75% hike. So as investors are making trades between today, tomorrow, and the rest of the week, they are anticipating that really high hike. So that could mean that stocks get very volatile because of these expectations. The reason that a lot of investors and Americans and experts and businesses are all saying that we're going to have these huge hikes coming from the Federal Reserve in 2022 is because of, one, the Consumer Sentiment Index released by the University of Michigan. The last report for May showed that Americans are really worried about our economy right now. They believe that inflation is going to go up, things are going to get a lot more expensive, meaning they won't have as much money to spend, meaning they're not going to go out and spend as much money. That is a worry for our economy and something that the Federal Reserve has to address in order to get our economy back on track. And of course, the Consumer Price Index number 2 was released for May, and that basically showed that inflation was going up and it had not peaked yet in our economy. This is all despite what the Federal Reserve has done with its interest rates so far and its monetary policy. So with all all of that in mind, the Federal Reserve might need to get even more aggressive with inflation. And as far as expectations go, I don't think we're going to see a 75 basis point hike from the Federal Reserve, and here's why. The Fed, as of lately, even though we have this really bad inflation problem, has not got aggressive enough, and they have been pretty docile through the entire inflation process and with their monetary policy. I don't really see that changing in the future. I think they want to be very careful and walk on eggshells right now. I don't think they want to do too much in order to cause a recession or eliminate too much demand from our economy. So what I'm anticipating is a 0.5 basis point hike, the exact same one that we saw back in May. This is going to show that we're going to be well over a 1% federal funds rate, but it also shows that the Federal Reserve is getting aggressive on inflation and doing what they can, all while not creating a recession. But regardless, this is going to be a huge move from the Federal Reserve and Jerome Powell. We have already seen that Jerome Powell and Treasury Secretary Janet Yellen have admitted that they were wrong about inflation before. So do they want to continue to be wrong, or do they want to try and do something really aggressive now? Like I said, I don't necessarily think that we're going to see an aggressive Federal Reserve just yet. I think inflation is going to have to continue to go up for them to do that. But they know that inflation is going up despite all of their monetary policy up to this point. Now, what exactly does this all mean for our economy and investors alike? Well, we can assume that our economy is going to continue to be restricted by all of these Federal Reserve moves. Like I said, when the Federal Reserve dropped their benchmark interest rates to 0%, that meant that there was so much money circulating throughout our economy. It was a lot easier for people to go out and get things like a mortgage or an auto loan or spend on your credit cards, because all of those things are affected directly by the Federal Reserve. Obviously, the Federal Reserve doesn't directly set interest rates for mortgages or auto loans in the United States, but the banks do. And if banks get their money from the Federal Reserve and the Fed is making it harder for banks to get money, well, then it's going to be a lot harder for you to use the bank's money. So with that being said, we can anticipate interest rates for mortgages and auto loans and credit cards to continue to rise in the United States. That means the average interest rate for a 30-year fixed mortgage could go up to 5, 6, and 7% on average all throughout the United States, pushing out a whole lot more buyers. That means if you're in the market for an auto loan or a mortgage, or you want to take on more debt with any type of loan, including credit cards, it's going to be a lot harder to do so. The average interest rate for a 30-year fixed mortgage in the United States is currently around 5%, but that could change very soon and go up to 6% or 7%. It just depends on how aggressive the Federal Reserve gets. Obviously, if they raise their interest rates to 75 basis points or more, then yeah, the mortgage interest rate average could go up to 7%, and the same could be said for auto loans. Credit cards in particular, though, are going to be very interesting because those all come with an adjustable interest rate. You kind of need to prepare if you have a lot of credit card debt right now, and you might want to think about paying a lot of it off as quickly as possible, because all of that debt is just getting more expensive as the Federal Reserve raises its interest rates. Eventually, it's going to drown you. All of that demand is eventually going to disappear from our economy, so you're going to have fewer people looking for mortgages, you're going to have fewer people looking for auto loans, and fewer people spending on credit cards, all because it's getting really expensive to do so. And again, it's really going to depend on how aggressive the Federal Reserve gets to where we see that demand really drop. If they get super aggressive, well, then that could suck even more buyers from the housing market, which has been hot over the last 2 years, and it could really start bringing up inventory, because now there are a lot of houses on the market but no buyers, and prices could eventually come down. Now, as far as the housing market goes and the auto market go, I don't think we're going to see an outright crash. I don't think we're going to see a explosion in those industries, because there is still a lot of demand. Even though demand is getting really low, demand is still much higher than it has been over the past decade. So there is a lot of demand and not nearly enough inventory, because inventory is as low as it can possibly be. It's going to take a few years for all of that equilibrium to finally level itself out, but eventually it will happen. It's all just going to depend on what the Federal Reserve actually does with its interest rates. Now, what about markets? So the stock market in particular, I think, is going to continue to be volatile, because a lot of that liquidity from the Federal Reserve is finally disappearing from the market. The Fed is rolling off billions of dollars every single month from its balance sheet, meaning it's not reinvesting, meaning all all of that money is not flowing into the stock market like it was in 2020 and in 2021. So investors naturally have a whole lot less money. This goes for corporate investors and regular everyday retail investors. Retail investors are getting hit hard because of inflation, because of the cost of living, because of everything going up right now. So they just naturally don't have as much money, and they don't have as much money to buy products, goods, and services. That is leading to lower sales, which is leading to a lot lower of earnings reports for companies on the New York Stock Exchange. They just don't have as much money right now. So as the Federal Reserve raises its interest rates, well, they can't take on any new debt to continue growing. All of that is going to disappear. Equity investments are going to disappear as well. So the volatility on the stock market is most likely going to continue, but it will get even worse if the Federal Reserve raises its benchmark interest rates way too aggressively. If we see a 0.75 interest rate hike tomorrow, well, then that could mean that the stock market is extremely volatile for the rest of this week. That is because most investors and most companies are not believing that the Fed is going to raise its interest rates that high, and they don't believe that they're going to pull that much money out of the market just yet. But if they end up doing that, well, then we could see a massive sell-off, which comes at a really bad time considering a lot of markets like the Dow, S&P 500, and NASDAQ are currently in bear market territory. There are a whole lot of sellers, but not a lot of buyers on the stock market right now. And that is going to be reflected in other markets as well, like the cryptocurrency market. That is probably going to continue to drop as the Fed raises its interest rates because investors can't use that debt. They can't trade on margin, and of course they can't make those risky investments anymore because they are trading with their own money and not Uncle Sam's. That could be a problem as Bitcoin and Ethereum continue to drop in 2022, and some major firms in the cryptocurrency space are laying off workers and essentially saying that your cryptocurrency is no longer safe if they go into bankruptcy, which of course is not helping the situation at all. So as we continue to see the Fed raise its interest rates and pull a lot of that liquidity out of the stock market and other markets, well, then that could mean a crash in crypto and possibly the stock market, depending on how aggressive they get. Now, in terms of what you can do to prepare your finances, I think that markets are going to be really volatile. I think that the cryptocurrency market and stock market are going to be way up and down for a long period of time. Do I think it's going to last? Not for the foreseeable future. I think in the short term, definitely, as the Federal Reserve continues to get more aggressive on inflation and more aggressive with their monetary policy, then yeah, the stock market is going to be volatile, but eventually it will level itself out as our economy typically does when it's in recession or bear territory. What this means for you though is an opportunity. You can essentially buy the dip on a lot of these companies that are really low in value right now and get in at a discount. You can buy up a lot of these stocks that you wouldn't be able to afford before, all at a discount, and start growing your wealth. Also, take this as an opportunity to look at your budget and look at where your debt lies. If it lies with an adjustable rate interest rate like credit card debt and some adjustable rate mortgages, well, then you might want to consider putting a lot more payments towards those things in the short term. As the Fed raises its interest rates, those types of debt are just going to get more expensive, meaning it's harder for you to pay them off. And normally this wouldn't be a massive deal, but because inflation is so bad right now, everything is going up in price. So it's kind of a double whammy in the red for your finances. And keep an eye on your treasury yields. As they continue to go up, well, that shows that investors are no longer wanting to put their money into treasury bonds, which means a lack of government spending for the United States. And all in all, I expect inflation to continue to be a problem in 2022. I don't really think that the Federal Reserve is going to be able to drop it just yet. I think that the Fed is going to be able to lower it a little bit throughout the entire year, but it's going to remain high as energy and shelter costs continue to go up. The war between Russia and Ukraine is making gas prices go crazy, and also we still have a lot of bad supply chain issues. All of that cannot be fixed by the Federal Reserve. So inflation is going to continue to go up. Many experts are saying that it could get as low as around 6 to 7% in the United States, and I think that's pretty close. But throughout the summer of this year, as people are traveling more, as people people are using a lot more gas, as people are buying homes still, well, then inflation is going to rise. Because energy and shelter costs comprise a huge portion of the CPI, well, then we are going to see inflation probably hit above 8.7 to 9 and even maybe 10% in the United States. And for the future, the Fed may raise its interest rates even more in July by possibly another 0.5% or by 0.75%. It's really just going to depend on what inflation is and how fast it's really going up. I think if they continue to see that energy costs for Americans are going up, well, then they don't really have a choice but to try and lower everything as much as they can from their end. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all of the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.